Good morning. My name is Nev of One Deal Away, and welcome to my summer office, as you would. So you might hear a bit of a background noise every so often because I am outside. I do come out here to work during summer, typically morning because the sun tends to come this way, and then it gets a little bit too hot, so I go somewhere else, sometimes beach, sometimes indoor to air conditioning. But today I wanted to do something very interesting and very unique, very different. And that all came from a question. Not that long ago, I have posted about a young man. I want to say he was in his 20s that was doing some exotic trades on Robinhood app that had caused him to find himself deeply in debt, almost $750,000 in debt. And I posted that news as a sort of um, awareness building component to say you got to be careful as to what you do and how you do stuff. You got to learn how to do certain things before you just jump in, because Robinhood and all the other apps make it super easy to get in, right? You jump in, you press a few buttons, it's very easy. You can go into all these different markets, and sometimes we don't understand what we're doing, which is what can cause problems. So one of the folks, when I posted this stuff, and here's the noise, I promised it would happen. One of the folks that when I posted this said, how is this even possible? I always thought that you can only lose what you put in. And so today I want to explain to you how when you trade different things could potentially cause you to lose more than what you put in. So I'm going to share my screen. And once I do that, then we're going to go in and take a look. Now, right over here, you are able to see my sort of whiteboard, if you would, and hopefully you can see things right here. And right here on the left-hand side, right over here, you can see the sort of typical things that we invest in: stocks, bonds, ETFs, mutual funds, right? And for that component, unless they're leveraged, and I'm talking about ETFs and mutual funds, which mutual funds are typically not leveraged. Typically, you see leverage with the ETFs. It is that what you put in is what you can lose. Now, even with the ETFs, when you put in $1, all you can lose is $1. However, when it's a leveraged ETF, exchange traded fund, right? ETF fund, then you actually just go up. If it's a 2x leverage, then you can gain twice as much on the movement or lose twice as much. So it just sort of makes it exponential. So that's a very simple thing that most of the beginning investors kind of get into. Now, of course, we have multiple other things. We have futures markets, we have options, we have, like trading on the margin, that kind of stuff. So I will attempt to explain a little bit today as to, I don't know exactly what the young man used, but just to use that to explain how you potentially could go from, putting $1 but losing 100. And a lot of that will come from options. Now, what are options? That is going to be one of the questions. Well, options are pretty much what it says. It gives you an option, but not an obligation to either buy or sell an underlying asset class, right? It's kind of like when you go to buy a house, for example, right? You put in a contract saying, I'd like to buy this house, but I want to evaluate it. So you have this 10-day period to evaluate whether you want to move forward with it or not. That's an option. That's an example of an option. Now, right over here, so that we're not making things up, I want to go in and share with you sort of what is a put option. So you have two different things. You have a put and a call when it comes to an option. So a put option is a contract that gives you the right, but not an obligation to sell. Let's write that down. So this gives us an ability to sell an underlying asset. Okay, we'll talk about strategies in a moment, but I just want you to understand. Now, of course, you can probably guess what a call is, right? And a call is an option, but not an obligation to buy. Okay, those are important metrics. We're going to circle them so that you can understand them. Okay, and of course, we can go in and sort of say, well, what is the call option, right? And it says call option is the option to buy, but an underlying asset, right? So it's an option, not a sort of an exclusive thing that you have to do it. No. here's kind of how and why sort of options exist. Now, of course, you can speculate with them, and this is where folks end up making or losing money. Now, both calls and puts, we're going to change the color, can actually be naked, okay, or they can be covered. And when I say naked, I'm not talking about that you sit naked and trade, although it wouldn't shock me if some people do. It basically means that I don't have an underlying asset when I am buying or selling these options, right? Covered means that I do. So for example, let's say that I have 100 shares of Ford stock, okay? Now, if I have that and say I bought it at $2 a share, okay? I could buy a put option, which is that a right to sort of sell, but I don't have to, at say strike price of $1.50, for example, right? We're using this as an example only, okay? What this does is provides me with a covered put option because I already have the underlying asset, right? And if I buy one contract, you have to remember that when we talk about options, oops, sorry, wrong direction. When we talk about options, each one of these things, okay, each contract, so one contract means that there is 100 shares within it, okay? So 1 to 100, okay? So I would buy, in this particular case scenario, I would buy one put option contract on my share of Fords. Now I have a covered, uh, covered position. So what this does, it basically protects me that, say that I am afraid, it's sort of like a hedge, right? I am afraid that the Ford stock might drop down to say $1 per share. That means that I'm going to lose 50%. And I'm saying, that's a bit risky, right? So I want to protect myself by buying this particular put so that in case something does happen by the time this put comes to expiration, because all of them come with sort of the end date, right? They don't last for forever. It might be end date might be in July, it might be in December, it might be in June of next year. So there's different dates, and it gives me an ability that should this Ford sort of drop in by the time this comes to expiration, that I can then sell my $100 to the person that actually sold me the put. So I would end up buying, right? This is Nev, okay? Okay, and so I buy the put, and then we have a seller of the put, okay? Let's put the seller right over here, and also known as the writer of the put. I don't have to remember all of these things. I just want to explain kind of how it works. So if it does drop, I basically say, hey, Sally, the seller, okay, I do want to actually sell this stuff. So then Sally, because she wrote this stuff, would have to end up buying, potentially losing money, because if it is trading at $1 and I sell it at 150, Sally is actually paying 50 cents per share premium to basically run with this stuff. Now, the reason that most people go into the options is because vast majority of them, let's change colors for just a moment. All right, let's go with electric blue. Most of them expire worthless, okay? Most of them expire worthless. And so if that is the case in this scenario down here with this Ford component, that basically means that Sally would end up earning the premium without ever having to sell, buy, or do anything with the stocks. Okay, cool. Now, what is naked then? So naked by definition, okay, so let's move it right over here. So we're gonna run naked right over here. Naked by definition means that I am basically buying or selling either a call or a put without the underlying asset. So for example, let's say that this is me yet again, right? And I buy, okay, one put contract on Ford at $1.50. Okay. Now, put gives me an ability to sell, right, without an obligation. But if I don't own, and I own no Ford stock, okay, I own none of it. That is naked, okay? So when I go and buy a naked put, it's not necessarily a big deal. And the reason that it's not a big deal is because it gives me an option to sell, but not an obligation. So even if Ford, for example, so it could be an interesting sort of component. Let's say Ford does indeed drop to $1, right? Okay. Right around the expiry of this contract. I potentially could then go in, buy 100 shares of Ford at $1, okay, and force Sally to basically to execute my put contract and force her to buy. Now, what is the difference between all of this stuff? Now, I could be potentially Sally, right? Now, Sally, in this case scenario, we don't know if she has cash. We don't know if she has an underlying asset. And so potentially, if either one of the scenarios was to happen and I force her, if she doesn't have money, she would have to borrow, okay? Or if she doesn't have money, if she doesn't have, you know, the money or the shares. Now the naked puts are not necessarily as risky. It's really naked calls that have a very high risk, because potentially, you know, if I was, right, Sally, and I am selling a naked call. Okay, and what does that mean, right? Naked means I own 0 shares of Ford. I'm going to continue with Ford, not to pick on them, but it's easier to write F than anything else. Call means that it's a, right? And you remember, it's a buy, right? Right here, okay? So call means buy. Now, if I, right, if I buy a call, that means that somebody has to sell. Well, in this case, Sally is selling this particular take, right? So if I buy it, I have an option, okay, to buy. But because Sally is selling, she has an obligation, okay, obligation to buy should I decide to go forward with it. So how does that work? Oh no, sorry, that was not supposed to happen. Okay, how is that supposed to work? So let's imagine that here is Sally, right? And Sally is selling a house, right? Now, here is me, and I want to buy this house. To buy this house, I put it under the contract, which is sort of like an option, right? Here's my contract, and basically says to Sally that, hey, I want 10 days to inspect, and you have to sell me this stuff, because if Sally doesn't, then there's sort of she has a legal obligation as a, you know, as it would be put in through a contract. Now, I could potentially walk away if my contract allows me to do that stuff. So I am buying basically an option, okay? Option to buy, okay? But Sally has an obligation to sell. Because if you think about it, on every side of the transaction, right? Every transaction, so every transaction has 2 sides. It's an equation, right? You have sell and you have buy, okay? That's, every transaction has that. So now let's go back to my naked call. Oh, where is my naked call? Okay, so my naked call basically says that Sally is selling a naked call, meaning she has 0 of these things, and she has an obligation that should I go in, A problem comes in with these particular things is because none of us know exactly how the market is going to go. So when options were created really as a hedge, as a coverage to sort of say, hey, if things move up, move down, I can protect myself and limit my losses and maybe improve my gains. But somewhere down the line, of course, people started buying and selling these things. And so when you go in, you potentially could find yourself in a position where you're forced to buy or forced to sell something that you don't have. So naked is actually the component that makes it very, very risky. When you own something and you have to do it, then it's easy, right? Imagine if you were to say, well, I'm going to naked sell a house. Now, not naked show up to sell a house. I'm talking naked selling, right? I don't own a house, but I'm going to go out there and sell it to somebody on the market. Now, obviously, in the real world of real estate, that's called fraud, right? But unless you have an option to say, well, I can quickly buy it from the current seller, right? And then flip it over to you and potentially I can make do. The problem ends up happening is that you don't know what the current seller is going to do, what the price is going to be. So you're running a huge risk of finding yourself in a position where you're selling something you don't own, and now you have to potentially borrow or pay way more than it costs you in order to sell it, causing you to lose funds. So that's one of the ways that you can find yourself in trouble. Okay. Another one of the ways is that you could actually go in. Oh, I forgot to share my screen. Sorry about that. Another one of the ways that you can do and find yourself in this deep trouble is to go in and sell short. Okay. Now, sell short makes sense that if I'm expecting a stock market to do something and then go down, right? Then I'm selling short. I'm shorting the market. I am basically betting that this is going to transpire. Now, how do you sell short? Well, you actually have to borrow money from the broker, okay? Borrow money. Then you have to basically buy the short contract, right? To go in. And then if it goes down, for example, then you actually have to buy it, okay? Pay the settlement, and hopefully you make money on the difference over here. Now, what ends up happening is that a lot of folks also trade on a margin, meaning I will go to my broker and say, look, I have $100,000, right? $100,000 that I want to put in the market, okay? But I want to actually trade with more than that. So can I borrow Mr. Broker, can I borrow some money? And they'll say, sure. And they typically have some sort of leverage collateral, right? So they might say, well, with your 100K, you can trade with 200K, okay? Now I can go in because I'm using borrowed money and I can buy 2 times as much stock. Now, if I'm buying short and it goes my direction, I make money, right? If I'm buying long and it goes my direction, I make money. However, when I go in and I end up buying something and I think it's going to go this way, but in reality, it goes this way, I lose money. Now, what ends up happening is that my account, okay, goes down. And because I have to have 50% in this particular case, collateral down, is that the broker basically says, right? So there's Mr. Broker, and the broker says, you owe me money. You got to deposit extra cash, okay? Or we're selling your entire portfolio, whatever we have to sell in order to meet the margin. It's called a margin call. Now, of course, if you do have money, you put it in. If you don't, they end up selling stuff. And if the value of this is only, say, 50K, but you end up owing 200K because that's what you ended up borrowing, right? Leveraging and all of that stuff. Now you end up being negative 150K in the account and end up owing money. Okay, so that's how this particular component happens. So The best thing that you can do is that if you are going to trade on margin, if you are going to trade leverage, if you are going to go into the options and do some of these exotic and fancy things, the best thing that you need to do, absolute best thing to do, is to spend time and a bit of money and a bit of energy to go and learn how to do these things, not just jump in it. If you're not willing to go in and learn, then I suggest that you just sort of stay out of that stuff altogether, because there are many risks, and a lot of times newbies, even professionals, lose a lot of money in these markets. Okay, but newbies especially. All right, and so that's kind of what my advice is stay out of this stuff. Obviously, you can do whatever you want. I am just sort of as an educator, as a teacher, who is very much concerned about people doing stuff that they don't know, they don't understand the risks and how it all works. My recommendation that I have for you is, if you want to do some of these exotic things, spend time, money, and energy learning how to do this stuff. Find a mentor who's doing what you want to do. Invest a little bit of money and time with them in order for them to support you through the times and help you. Then once you start learning, you definitely want to do paper trading first, which basically means I'm monitoring the market live, and only on paper or on a computer screen, however you want, I'm putting in what my buy and sells would be to see if my analysis, if my thinking is matching. Once you come pretty darn good at that, that's when you can go in and start putting a little bit of money to see how you're doing. The problem is that vast majority of us don't want to spend money learning, don't want to spend time learning, and we don't want to spend time paper trading to learn how it all goes. We just jump in and put in stuff and just go bananas, because markets never go down. Markets do go down. Everything is cyclical, and you want and you need, not just want, you need to understand the risks before you go in order to protect yourself and not find yourself deeply in debt, struggling, and being financially stressed to your eyeballs. I hope this is helpful to you. Hopefully, Dave, this is answering your question of how is it possible that somebody can put in a little bit of money and end up with so much debt. Basically means leverage and exotics without much knowledge or experience, ability or appetite for risk, not understanding what's going on, and trades not going your way. Thank you for watching. Until next time, stay forever money blessed, and do remember, you are only one deal away.